What's up everybody, GenExDividendInvestor here. In this video I'm going to compare investing in dividend stocks versus non-dividend stocks to help you understand the various pros and cons of each. And if you laugh when someone says it's hump day, then please slam that thumbs up button, subscribe if you haven't yet, and click that bell notification. First of all, I normally say growth stocks when I'm talking about non-dividend stocks, but the reality is that there are dividend growth stocks and there are stocks that don't pay a dividend that don't have growth, so I'll just use the more accurate categorizations of dividend stocks and non-dividend stocks in this video. So what's better, dividend stocks or non-dividend stocks? Well, while I prefer dividend stocks, I also invest in non-dividend stocks, so it's kinda like asking me if blondes or brunettes are better, which I can't answer without more details. Sure, on average I like blondes more, but there are some amazing brunettes out there, and I actually married a brunette. Of course, she dyed her hair blonde, so I'm not sure what that means. My point is that you don't need to be someone who only invests in dividend stocks. You can do that, and you can do great, but I personally also like to be a shareholder in companies like Google and Amazon and Atlassian, etc. What really matters is that you invest in quality companies when they're on sale that are aligned to your goals, needs, and risk tolerances. That being said, now I'm going to tell you why, on average, dividend stocks are indeed better than non-dividend stocks. Come on, I run a freaking dividend investing channel. What else would I think? Sometimes I get comments where people say that they don't see the point of investing in dividend companies because all that happens is that their stock gets reduced by the amount of the dividend when it's paid out. Let's start with that. When a company declares a dividend, it sets a record date when you must be on the company's books as a shareholder to receive the dividend. Companies also use this information to determine things like who gets a vote in proxy statements. Once the company sets the record date, the ex-dividend date is then set based on stock exchange rules. The ex-dividend date for stocks is usually set to 1 business day before the record date. If you purchase a stock before the ex-dividend date, then you get the dividend. But if you purchase a stock on its ex-dividend date or after, you will not get the next dividend payment and instead the seller gets the dividend. The X in ex-dividend was part of why I'm GenExDividendInvestor and not GenExDividendInvestor. I'm part of Generation X, but I'm also an ex-dividend investor, so to speak. Now, after a stock goes ex-dividend, the share price typically drops by the amount of the dividend paid, like my comments mentioned. But according to Investopedia, dividend stocks often appreciate in the days leading up to an ex-dividend date by an amount equal to the dividend, effectively canceling out the drop that will also happen. If that's true, then why does that happen? Well, probably market psychology. If a company has a history of paying a dividend and the market feels that the company will continue to generate enough cash flow to keep paying one, then knowing stock prices drop by the dividend could cause enough extra buyers to prop it up beforehand to ultimately cancel things out. But that doesn't mean a dividend is free money. When companies pay a dividend, it normally lowers the cash on their balance sheet, and thus it lowers the equity value of the company. Companies can also issue stock dividends rather than cash dividends. Anyways, even if Investopedia was wrong in their assertion of how dividends often impact stock prices, or rather don't, I would still focus on dividend stocks for a ton of reasons. One reason is because historical data shows that dividend stocks outperform non-dividend stocks in terms of total returns, which alone becomes a compelling reason to favor them. Ned David Research analyzed the S&P 500 over the last 50 years and found that dividend growth stocks had an average annualized return of 12.9% as compared to the overall S&P 500 at 12.3% or non-dividend stocks at 10.9%. So dividend growth stocks outperform stocks that don't pay a dividend by about 2% per year. Let's look at a calculator to see how 2% per year plays out over someone's life. If we pretend someone starts with a $10,000 portfolio and invests $100 a month for 30 years into non-dividend stocks and gets a 10.9% annualized return, then they would have a portfolio that's worth about $534,000. Compare that to a person who gets a 12.9% annualized return from the dividend growth stocks and they end up with a portfolio worth $897,000, which means they're worth $363,000 more, i.e. 68% higher. That's an amazing difference. Which got me wondering, do dividend growth stocks outperform non-dividend stocks only in America? But then I found a study from RBC Capital that came to the same conclusion that dividend stocks outperformed non-dividend stocks over the last 35 years in Canada. They also concluded that dividend stocks had historically shown lower volatility than non-dividend stocks. Hartford Financials also concluded that companies that grew or initiated a dividend have experienced the highest returns relative to other stocks, along with having significantly less volatility. Morningstar and Hartford looked at the last 60 years of the S&P 500 and concluded that 84% of the total return of the S&P 500 can be attributed to reinvested dividends and the power of compounding. Incredible. This diagram explains things nicely. On the y-axis, i.e. going up and down, we go from lowest annual return near the bottom to highest annual return on the top. We see dividend growth stocks on top of the chart, which means they have had the highest returns, and stocks that don't pay dividends are near the bottom of overall returns, with stocks that cut their dividends having the worst overall returns. And then on the x-axis, going from left to right, is risk, which they synonymously use with volatility, with the left side being the least volatile and the right side being the most volatile. So not only are dividend growers the highest returns, but they are also what they call the lowest risk. Dividend growth stocks can let you have your cake and eat it too on so many levels. On average, they give the highest return, lowest volatility, and your cake keeps making more cake so you can keep eating it and the cake gets bigger over time. Things get even better when you look at the premier dividend growth stocks, i.e. those with multiple decades of consecutive years of increasing dividends, aka the dividend aristocrats. ProShares and S&P Global both found that the Dividend Aristocrats Index has outperformed the S&P 500 while having lower volatility. Of course, remember that historical performance does not guarantee future results. This data shows us that in the last 16 years, the Aristocrats had an 11.67% annualized return as compared to the S&P 500 at 10.71%. If you look at just the last 10 years, then Kiplinger's found that the Aristocrats Index has returned an annualized 18.3% as compared with 17.1% for the S&P 500. They also said that usually higher returns indicate higher risk, but the Aristocrats have achieved their returns with less volatility than the S&P 500. So what else did Kiplinger's conclude? Well, the Dividend Aristocrats have better moats relative to their competitors, and their moats allowed them to raise prices and keep profits flowing during tough times. Kiplinger's also found that dividends don't lie and that dividends are probably the best indicator of the health of a company. You can manipulate earnings per share, but you can't fake cash flowing out to shareholders. Dividend growth is often a direct reflection of management's confidence in the company's future. I'd bet the companies that pay dividends are run by management teams who are more prudent with their cash because they know a bunch of it is going out to shareholders, so they need to steward the remaining cash more carefully on projects with a high likelihood of success. Another thing I prefer about dividend stocks is that it often means that the company's management team is shareholder friendly, as they are literally transferring money from their control to shareholders. However, just because a company has dividends doesn't always make it a safe bet. Sometimes a management team can push a dividend in order to keep investors if the stock isn't moving. So make sure you understand why a dividend exists and for how long and what the various financial trends are in the company. Another finding that Kiplinger's had was that quality dividend companies often operate under management teams with conservative ideals. Management teams generally want to maintain a record of dividend hikes because they know how bad the stock can react if they cut. To me, a conservative management team is one that is careful, fiscally prudent, and risk-averse. Another Kiplinger finding was that dividends are a buffer in difficult times. For example, in 2008, which was the worst year for large-cap stocks since 1931, the S&P 500 lost 37%, but Dividend Aristocrats only lost 22%, i.e. they lost less, thanks to their moats, conservative management, and consistent payouts. Another example was in 2018, where the S&P 500 lost around 5%, but the Dividend Aristocrats Index only lost 2.7%. S&P Global concluded that dividends play an important role in generating equity total return. Hartford Funds broke down S&P 500 performance by decade to see how much dividends contributed to total returns in each time frame. What you see is that in decades where stock markets did poorly, dividends counted for the majority of the returns. Thus, in crappy markets like in the 70s, you see that dividends accounted for an astounding 73% of total returns. Imagine if you only owned non-dividend stocks during those periods. That would be tough. So what sort of macroeconomic things happen that give us low growth decades? Well, number 1, rising inflation. Number 2, increasing oil prices. And number 3, higher unemployment. Don't those things remind you of what we see in the markets right now? If so, then I really want to be a dividend investor. Not only that, but I think there are other trends that are happening and will continue to happen, which will further act as positive tailwinds for dividend companies. One is that the pandemic kept people at home and gave them more disposable income, both of which brought a whole new group of investors into the market. A bunch of them are learning about the FIRE movement for the first time, as well as what passive income and dividends are, and thus more are investing in dividend companies. Historically, boring dividend investing was often relegated to an older demographic. Combine that reality with the fact that more baby boomers are now going into retirement, many of which need yield-producing investments, and you have a formula of multiple catalysts to keep pushing classic dividend stock companies up faster than non-dividend companies. And yet another positive catalyst is that more and more people realize that we will have a crash at some point, and that should lead to more money pouring into safe companies like boring dividend stocks, as they are usually the best way to outperform in bear markets. I recently showed you why dividend stocks love flat markets in a video I did called Dividend Investors Rejoice, 0% Market Returns for 10 Years, where I modeled how a dividend portfolio that was dripping would probably do if the stock market went sideways for a decade. I also showed you how dividend stocks do even better in down markets in my video called Why Dividend Snowballs Love Stock Crashes. Okay, so we established that dividend growth stocks have generally outperformed non-dividend stocks. That doesn't mean that some non-dividend stocks don't do amazingly well. Nor does it mean all dividend stocks do well. Nor does it mean there aren't periods of time where non-dividend stocks outperform dividend stocks. For example, non-dividend stocks did better in the run-up to the dot-com crash due to the tremendous upside the internet stocks had, most of which didn't pay a dividend. So dividend stocks sometimes beat the market because companies that pay dividends also tend to have stronger business metrics. But it's not the dividend which helps them outperform. What I mean is that the mere fact that they have a dividend doesn't magically mean they'll beat the market. Stocks that tend to do well are from companies that allocate capital intelligently and are profitable, something that is normal to see in strong dividend companies. Dividend companies often are generating more income than they need to operate and grow, all of which means it's probably a decent company, and helps explain why some people prefer to only invest in dividend stocks. Dividend-paying companies tend to be more stable and reliable because companies usually don't pay a dividend until they've been around for a while, are established, and now might have more cash than they can effectively use. When you buy shares in a company that has raised its dividend for multiple decades, it shows that the business model has succeeded for a long time. Non-dividend stocks often haven't been around as long, so usually have more uncertainty. Now, while some famous investors like Geraldine Weiss have successfully and consistently used dividend trends to identify stocks to invest in, I don't think that primarily only using dividends to evaluate stocks is ideal. However, using metrics like consecutive years of increasing dividends does make sense to me as part of your overall analysis, even though it's not guaranteed to identify a successful company. Of course, nothing is always guaranteed to work with investing. Like I mentioned, even if dividend stocks slightly underperform non-dividend stocks, I would still prefer them at this stage of my life. Why? Because they are one of the few forms of true passive income out there. I can do absolutely nothing and the cash flow pours in. I don't need to be trading stocks, I don't need to talk to other people, nothing, and the money keeps flowing in. Non-dividend stocks provide much more variable returns. Sure, I can set my target price to sell a stock, but the market is inherently unpredictable. I don't know how long or if my strike price will be hit. I'm someone who really values things that can free up my time so I can do what I want. I also really value a low-stress life. I've always found non-dividend stocks to be more stressful and less predictable. Since my goal was buy low and sell high with non-dividend stocks, I feel like I needed to be more actively engaged in those stocks in the market. I prefer just buying and then collecting the dividends forever. That doesn't mean I never sell. Actually did a video on why I'd sell a stock, but over the decades I found that dividend stocks needed less time and were less stress. When the markets crashed, it felt like a punch in the gut for all my non-dividend stocks, whereas my boring dividend stocks kept producing like nothing happened. Each huge crash I lived through further solidified that I preferred dividend investing. I found it annoying if I sold a stock and it kept going up. As a dividend investor, I hardly need to deal with that. I also really value the fact that even if I died, my dividend income would keep flowing to my wife and kids. I can't understate how important that is to me. Knowing my portfolio can keep my family safe and secure gives me great solace, and it gives me peace that when I die, something I've created will continue chugging along, providing comfort to them. Non-dividend stocks can't go on autopilot, providing income for my family if I'm not here, unless I have a relative or an advisor or someone that can manage the portfolio for me, which I'm not keen on doing. I put a lot of value on simplicity and automation, and dividend stocks do just that. So I get less stress, and it also gives me the most precious resource of all, time. Time I can be with my family and friends, or playing video games, or watching movies, or working out, or doing fun things like this video. I love that I don't have to babysit my portfolio. I love that I can walk away from the market and my portfolio keeps producing. I don't need to click the sell button to pay my mortgage. I don't need to worry about the number of shares going down. I don't need to think, oh no, the market has crashed, I can't possibly sell it now. All of those things I dealt with for years as a growth investor, and I love that I hardly need to deal with any of that. And that less stress and greater time that dividends have given me, well, that's all worth more to me than the fact that dividends outperform. I've had some hellishly stressful jobs over the years, ones where I'd have to work 100+ hour weeks amongst toxic execs. There were also amazing employees, but one powerful toxic person can really spoil things. So low stress and time on my own is beyond valuable to me. I like the simplicity and lower risk nature of dividend stock investing. Of course, with higher risk can come higher rewards. Like, I'm up over 1,000% in my Tesla position, but I feel it's a heck of a lot riskier than my dividend stocks. A comment I sometimes get from people who don't like dividend investing is that they don't like to be forced to receive a dividend whenever the company wants and however much they want to give. That person usually says they prefer to just create their own dividend by selling some shares. As an example, Amazon might not have dividends, but you could always just sell some Amazon shares every quarter to basically replicate getting a dividend, and it's arguably better to manufacture your own dividends because then you can control when you get the dividend based on a stock price you want, rather than when you're forced to take one. Thus, you can tailor the payout schedule based on need and optimize pricing. That way you can also control your taxes better. That's all true to some degree, but for the previous reasons I've all mentioned, I still prefer the classic dividend route. That's part of the beauty of investing. One person's trash is another's treasure. Now, one complaint I've heard about dividends is that you're often double taxed, because first the company often pays a tax on their earnings, and then when you get the dividend you also have to deal with it. That's basically immaterial to me. What I'm focused on is my bottom line dollar, and the reality is that without wage income I can make over $100,000 a year of qualified dividends and pay $0 in federal taxes, so I don't give a rat's behind if the company got taxed the dividend. Many companies these days have armies of accountants to avoid paying taxes to begin with, and regardless, what matters to me is how I'm personally impacted, which I'm effectively not. Dividends just have too many benefits over non-dividend paying stocks. Like drips. I love how dividend stocks held in retirement accounts can compound and grow tax-free without any human involvement. Dividend snowballs are real, and you can't do the same with stocks that don't pay a dividend. Your non-dividend stocks can appreciate, like your dividend stocks also can, but the compounding aspects of dividends buying more dividends keeps getting more powerful as time goes on. My dividends have gotten to a point where they literally pay my mortgage and health insurance and etc. It's because of dividends that I was able to retire. They are honestly amazing, and I desperately wish I could get the word out to more people in the world. Like to people that are freaking out about how they can ever retire. People that are sad that they missed the days when companies had pensions. People that are worried that they might live longer than their retirement accounts can handle. If you have to sell stocks, then you're probably following the 4% rule, and unfortunately if you live too long, then you can run out of cash. That's basically something you don't have to worry about if your dividends can cover your expenses. Which leads to another reason why dividend stocks are better, which is that since you aren't following the 4% rule and you're living on your dividends, that means you aren't selling your principal and you'll probably have a better nest egg to leave to your kids or to charity or whatever. And dividend investors don't need to sell their stocks and still get a return on their investment. As dividend cash flow comes in, they can invest it or use that cash for expenses. Dividends accelerate your payback on an investment. It's kind of like dividends provide a safety net to your investing. The same isn't true for non-dividend stocks until you sell, and then that's only true if they've appreciated. Dividends start flowing in relatively quickly once you hold the stock, and strong companies that pay dividends can keep paying you for your life and beyond. Another reason I prefer dividends is that they tend to grow over time from dividend hikes, which are both fun and motivating, and which increases your cash flow and usually beats inflation. Regardless of the type of stock you invest in, you should be aware of how interest rates can impact you. Some sectors with heavier debt loads, like utilities, telecom, and REITs, can be more price sensitive to interest rates. As rates go up, these sectors can sometimes get extra downward pressure on their stock price and vice versa when rates go down. It kind of makes sense. When interest rates go up, then you owe more interest on your debt, which often comes out of your profits, which can also make your discounted cash flows look less compelling, all of which can contribute to downward pressure on stock prices. Other asset classes like bonds also get affected by changing interest rates. For example, when the Fed raises interest rates, it can lead towards downward pressure on bonds, which can then be a catalyst for bond investors to look to dividend stocks for income. Inflation is another measure you want to be aware of. I recommend you watch my video called What Stocks Do Better with Inflation. Another reason I like dividend stocks more is that they promote a buy and hold investing mentality more. In my experience, dividend investors tend to panic less when their stock has a few bad quarters or even when the market has crashed. In fact, experienced dividend investors often celebrate crashes because they're an opportunity to acquire more income-generating shares on the cheap, as well as their drip grows faster. While crashes can also be useful for non-dividend stock investors to acquire more shares, in my experience they have a lot more freakout factor because if they sell in the crash, they know they are getting much less than they did before the crash, unlike the dividend investors which keep plodding forward with their slowly increasing income almost regardless of what the stock market is doing. In my experience, people who focus on non-dividend stocks tend to trade more, and the more you trade, the more people tend to lose. Not always, just often. Now, one area where non-dividend stocks tend to outperform dividend stocks is in sudden growth. It's pretty rare for a dividend stock to 10x in a year, which is why some argue that younger investors should focus more on growth stocks. Another comment I sometimes hear is that people don't like dividend companies because they think the company should be using that cash to innovate and grow more. Sure, in the early part of a company's life, it makes sense to use cash to grow the business. But once they are mature and competitors are all over and opportunities for high growth have diminished, I think it's prudent for the company to carefully allocate capital only to those projects where it thinks it can get high returns, and then give the rest of the cash back to shareholders. Why would I want a management team to force cash into projects where they didn't think they could garner high returns? The last thing I want is a bloated company that runs like the government, throwing cash just here and there without diligence. No, I want them to do a lot of analysis on the best ways to optimize their cash and only use it on the highest returning projects that best enable business goals, not do every project that someone dreams up. A quick side note, I actually think the best way for a reliable long-term income is to invest in low-cost index funds rather than single stocks for the average person. ETFs can give you a lot of diversification and gives you an easier investment strategy of just consistently dollar cost averaging into the ETF regardless of what's happening in the market. A portfolio of single stocks will probably have more risk due to being less diverse, which also probably means you will be subject to more volatility, and you'll need to be much better at business research and analysis. Now, for me personally, I enjoy spending time researching my companies. I love reading about their products and how they do in a quarter and stuff like that. I'm a junkie for it. I get a lot of motivation from owning single stocks. Like, I have pride of ownership when I see a McDonald's across the street, something I feel much more when I own it directly rather than as part of an ETF. And that pride of ownership has been a motivating factor which has helped keep me investing for decades. Think about how many things you've done for 1 decade. Working out? Eating right? A hobby? Your relationship? Very few people manage to do anything for a decade, let alone multiple decades, even when it's good for them. But dividends aren't magic, though I think they're almost as cool, and you still have to do thorough analysis before you invest in dividend stocks. A classic mistake is thinking, if yield is good, then higher yield must be better. It's sadly not uncommon for me to see new dividend investors just picking an almost random group of the highest dividend paying stocks that they can find for their portfolio. This is often a recipe for disaster. I was literally just talking to a guy who was telling me about this awesome dividend stock that pays 10%. I asked him why it was awesome and he said, because it's 10% yield. So are dividend stocks better? Yes, on average they are. But there are also great non-dividend stocks, and don't forget what I said about ETFs. There are a lot of ways for your portfolio to win. Speaking of portfolios, M1 Brokerage has a promotion running for a free cash bonus for new users that I believe is $30 right now. The way it works is you click on my M1 referral link in the description of this video, and then either open a brokerage account and fund it with $100, or open a retirement account and fund it with $500. Then you need to keep your money inside the new account for 30 days from the date of deposit to get the free bonus. Make sure to check the details before you sign up. Okay, now I'd like to do a shout out for some nice people who watch me on YouTube that have recently signed up on my Patreon to support me at the Aristocrat tier. So thank you Aaron Moore, thank you Beautiful Doubt, thank you Boaz, and thank you WM Steven32. Aristocrats gain access to my dividend spreadsheet product that I use in many of my videos, and they gain access to multiple private channels on my dividend Discord chat server, where I let my upper tier Patreons watch my videos before I release them to the public, as well as let them vote on which thumbnails I use for my videos, and of course they get more direct access to me. I strongly recommend you join my free dividend Discord, which has thousands of investors on it from around the world. Finally, unless you're a communist, then please hit that thumbs up button, subscribe if you haven't yet, and click that bell notification. Thanks for watching, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.